Keki Mistry, Vice Chairman and CEO at HDFC, joins in on the show. Keki, hi, morning. How do you view RBI stance on the monetary policy, and what, according to you, are the key government policies that would help revive investment climate right now?
Yeah, I'm sure there are a few. If you look at let's first talk of RBI, then we can talk of policy reform. RBI stance over the last 1.5 to 2 years has really been on how to curb inflation. So it's all focused towards inflation control. Now, inflation has not really come off, and therefore for RBI to now start cutting rates would have been a departure from what they always did, and they would, in the sense that they would now start looking at growth and not at inflation. So one has to appreciate it from that perspective. Having said that, some reduction in, if not the interest rates in CRR would have helped, because liquidity in the system is very, very low. If you look at it yesterday, for example, the total amount of money that was borrowed by banks from RBI was over 100,000 crores. So that level of borrowings is still very, very uncomfortable. And if liquidity is infused in the system, then automatically banks will be in a much better position to pass on the benefit of lower interest costs to their borrowers. So CRR cut is important. Having said that, the RBI did say that we would provide enough liquidity in the system through OMO operations. So I think that is very, very welcome. Now, one of the issues that you have to look at when we talk of inflation, and I've said this before also, is the fact that if you look at it globally, things have slowed down dramatically, particularly in Europe and the US and so on. And that has brought about significantly lower commodity prices, particularly oil prices. So you take crude as an example and take the month of March and take the month of June. In March, crude prices were $120 a barrel, and today we are looking at crude in the range of $96 to $97 a barrel. So that's a massive drop in oil prices. Now, we should be one of the biggest beneficiaries of falling crude prices, because we are such a large importer of oil. Unfortunately, we are not getting the benefit of that lower crude prices, because the currency has depreciated so much. And that seems a little odd, that when the rupee was at 48, oil was 120, and now with oil at 96, we are seeing the rupee at 56. So oil has come down 20%, which should logically make the rupee appreciate, but in reality the rupee has depreciated 20%. So we are not getting the benefit of lower commodity prices, which could have helped the process of bringing down inflation and therefore given more ability to RBI to cut rates.
Keki, what is the future outlook in terms of growth for the housing finance industry, and where are you seeing traction in the housing market? Because sales have stalled and developers are holding on to prices.
I am not so sure about sales slowing down, because we are not seeing any signs of sales slowing down. If you take the year ended March 2012, for which the results are public, our individual loans, which is loans given to average middle income consumers, has grew by 27%. The loan book in March 12 was higher by 27% compared to the loan book in March 11, and this is all retail as in individual loans. Maybe the reason is that we cater to middle income customers, people who are buying a house because they need a house to stay in. They are not investors or speculators, and they are end users. And if you are an end user, you're confident about holding on to your job. You're not going to not buy the house just because stock markets are higher or lower, or interest rates are higher or lower. You take a floating rate loan. So at the point of taking a loan, where interest rates are is not very relevant, because when it's a floating rate loan, you will get the benefit of falling rates whenever rates do come down. So we've not seen that slow down. And even if you look at the first 2 months of this year, April and May, I don't want to get into financial numbers at all, but we have not seen any slowdown in growth in April and May. So that makes us believe that the sales are happening. Maybe at Mumbai things have slowed down. Mumbai slowed down last year also. Mumbai things have become a lot slower. The process of getting approvals for properties last year was a lot slower in Mumbai, and that probably explains the fact that sales in Mumbai are slower than what they were before. But if you look at the middle income segment, the growth is still very, very strong. Our average loan size for the quarter ended March 12 was 19,50,000 rupees. And if you take a 65% loan to value ratio, which is what it was, we are looking at a property price which is under 30 lakhs rupees. Now 30 lakhs is middle income housing, and that market is growing very well.
So, Keki, is there a possibility of regulatory changes like increase in capital requirements and increase in provisioning requirements?
No, we don't expect any capital requirement to be increased, and we don't expect any provisioning to be increased. There is an interview of the chairman of the National Housing Bank less than 10 days ago, or maybe 2 weeks ago, and in that interview he has very categorically stated that the asset quality of housing finance companies is very good, and they are more than adequately capitalized, and therefore he does not perceive the need to increase capital for housing finance companies. Now, when you talk of provisioning, you take our own case, you take the numbers as of March 2012, we were carrying a total provision in our books of 1,671 crores of rupees. Out of that 1,671 crores, only 318 crores of rupees, 318, was in respect of provisioning made for non-performing loans or substandard assets. Everything else was provisioning made for standard assets, where there is no delay, which assets are of good quality, they are standard assets, payments are being made every month. So we are carrying such a huge amount of provisioning, and that in the context of the fact that historically, over the last 27 years, our loan losses have been only 4 basis points. So I don't think provisioning can even remotely be expected to be increased, and I certainly, and the NHB chairman's interview would show that there is no plan to increase capital.
Keki, what are your overall credit growth targets, and then credit growth targets for individual and the developer loan segment, and then what is the mix you would like to maintain for the developer and the individual loan segment?
See, we have always talked to our investors of a growth in the loan book of between 18 to 20%. That has been our target for the last 2 or 3 years. But if you look back at the actual numbers in each one of the last 2 or 3 years, the actual growth has been much higher than the 18 to 20% number that we were talking of. When you look at the breakdown of the business between individuals and non-individuals, 2/3 of our lending at any point of time is to individuals, and not more than 14% of 14% of our lending would be to property developers. Even when we give a loan to a property developer, we are not funding his balance sheet, we are actually funding a project. And we have an escrow account, we make sure that the disbursements that we make go into the escrow account, we monitor the use of money from the escrow account to ensure that the money is used explicitly for the construction of the project. Once an apartment is sold, the sale proceeds come into the escrow account, from the escrow account we pull our money out. So that's the way the system works. And that would account as of 31st of March for about 13%, 1/3 of our loan book. Now what happens is that individual loans also qualify as priority sector lending, and we sell some of these loans. So on 31st of March, we had a total of 14,500 crores of loans which have been sold by us, but on which we continue to receive income. Now let me explain this. Supposing the underlying interest rate on a loan that we have sold is 11%, and we have sold the loan at, let's say, 9.5%, the customer continues to pay 11% to us. Of that 11%, we retain 1.5% as our income and pay 9.5% to whoever we have sold the loans to. So that then creates a stream of income for future years. Now, in the balance sheet, however, the 14,500 crores of loans which we have sold will not be appearing. And therefore, the individual component looks a little lower in the balance sheet than what the real number is. But on that 14,500 crores, we are earning income. So we need to include that as part of the individual business to determine the breakdown of lending between individuals and non-individuals. So 2/3 of our loans are to individuals, 1/3 can be to non-individuals, and within that, not more than 14%, 1/4, can be to property developers.
Keki, in the light of the slowdown in the economy, will there be a contraction in the spreads and margins? What is your outlook in that?
See, I don't think spreads are dependent on where interest rates are or not if you're keeping a matched balance sheet, and we try to keep a matched balance sheet. So we don't take any maturity mismatch, we don't take any significant interest rate mismatch. So as long as you don't carry a mismatch, interest rates really don't impact spreads that much. There may be an impact of 3, 4, 5 basis points, maybe 6 basis points at most, either way, and nothing more than that. So our target is that our spreads must be in the range of a minimum of 2.15 to a maximum of 2.35. So if you take the last 7-8 years or maybe even a little more, you'll see that the lowest level of spreads we've seen have been 2.15, the highest level of spreads we've seen have been 2.35, and we would continue to believe that spreads would remain somewhere in that range.
Keki, let's change gears. Let's move away from the mortgage business to the insurance business. At what run rate do you think your premiums in your life insurance business will grow at? And then at what average do you think the industry or the insurance industry will grow at for this year?
See, let's talk with specific reference to HDFC. The first 2 months have seen a reasonably good growth. Again, these numbers are not public at the moment, so I don't want to get into those numbers, but the two months have been good months. We would be looking at a growth of somewhere in the teens for the current year in terms of new business premium. Now, insurance industry was growing very rapidly till 2010. In 2010, a lot of regulatory changes came by. Post those regulatory changes, businesses have slowed down. But if you look with specific reference to HDFC, if you look at individual business, for example, our market share has gone up to nearly 15.5% of private sector companies. Our embedded value is about 4,800 odd crores. I'm giving you numbers of March. Our persistency ratio is between 81 and 82%. Our expense ratio has come down to around 11.5%. So whichever way you look at it, we've done well. We made our first accounting profits for the year ended March 12, and we had profits of about 271 odd crores. So we are doing well. We expect the growth to pick up in the current year, and for the whole of last year, the total premium, not new business premium, total premium increase was 13%, 1.3. This year we expect that roughly that number for new business premium increase.
Keki, you had mentioned that going forward the share of the profits from subsidiaries will also increase. Give us some color on the same.
We see that happening, and that is because HDFC is now a very mature business with a large base. So we are talking of growth in business of around 18 to 20%. Hopefully we'll grow at a faster pace, but 18-20 is, what we've been talking for some time. But if you look at the subsidiaries, barring the bank, which is large, most of the others come from a relatively small base. So insurance till March 11 was making accounting losses. March 12 was the first year when the life insurance company made accounting profits. In the general insurance business, we would probably have had accounting profits for the year ended March 11 or March 12 itself. But for the fact that in the general insurance business at the last moment, we had this large motor pool debit, third-party motor pool debit, which we had to absorb. So because of that, we are in accounting loss for the year. But going forward for this year, for the year ended March 13, we expect the general insurance business to make accounting profits. So when you look at our profits on a standalone basis, last year they were 4,100 crores. And when you look at it on a consolidated basis, they were around 5,400 odd crores. So the subsidiaries add about 30%, or the share of profits of subsidiaries is about 25% of the total profits, and they add 30% to our profits.
Right. Keki, final question. Do you think the government will increase the FDI in insurance?
I mean, it's difficult to answer that question. We've heard this time and again from the government saying that they are looking at doing it. But given the fact that we have political compulsions at the moment, some of the easier reforms it may be easier for some of the easier reforms to happen, whereas this opening up of insurance for some reason has been a very controversial subject for so long that in these circumstances and the way things are now, whether they would open up or not is a little doubtful.